This is our second video on IAS 1. It's a total blank screen, so I hope it's not representative of what is happening between your left ear and your right ear, and that there's actually something going on there. All you have to do is you have to retrieve the knowledge. Right, the second one is all about the purpose of financial statements. What is the purpose of financial statements? Now, the first thing is it has to provide information. What type of information? Well, the first thing that we want to do is we want to know what is the financial position of the entity that we're looking at. Now, we know that the financial position is in the statement of financial position, and it is as at a certain date, and that is a reflection of the asset position of the company. How much assets does he have? What type of assets does he have? And what is the value of the assets? All the liabilities of the entity is also reflected in the statement of financial position, as well as the equity. The equity will then represent the total wealth of the entity, which belongs to the owners of the entity. The second type of information that a set of financial statements are actually providing is the financial performance of the entity for the full financial period, which is normally 1 year, 12 months. So in the statement of profit or loss and other comprehensive income, we are going to measure the net profit of the entity. If it is a company, it will be net profit after tax of the entity. So that is how well the resources of the entity, which is represented in the statement of financial position, has been used by the entity in the last financial period in order to maximize the returns that we've earned by utilizing those resources. And then the third thing that we provide information on is cash flows. What was the sources of cash flows? Where did they get their cash flow from? And then how did management apply that cash flow? For what did they use that cash flow? Because that is quite important to have an opinion of how well this company or this entity has been managed. So it is to provide information about the financial position, the financial performance, and the cash flows of an entity that is useful to a wide range of users when making economic decisions. Now, this last part of the sentence is also a very important part of the sentence. First thing is that who are the users of the financial statements? And we know that there is a lot of users. We have the receiver of revenue, we have banks, we have other providers of loan finance, we have creditors. Well, the shareholders of an entity itself is using the financial statements in order to see whether this entity has been well managed or not. And then the third thing is that the user usually make an economic decision based on the information in these financial statements, either on the financial position with your financial performance, as well as the cash flow situation of the entity. So I'm either going to decide whether I'm going to invest in this entity. If I'm the receiver of revenue, I'm going to make a judgment call whether the figures are reasonable and that the net profits are reasonable and that the tax that they say that they're actually owing me is a reasonable amount. And the same thing with creditors. What is the creditor or provider of loan finance going to look for? He wants to know what is the cash flow position of the entity. Will the entity be able to repay these liabilities and commitments in the foreseeable future? Now, general purpose financial statements, all of them has some general features which you have to know. Now, I'm quickly going to run through all of them, and then we're going to stand still one by one and discuss them. The first one is fair presentation and compliance with IFRS statements. Now, fair presentation, that seems to be a little bit familiar because when we did the conceptual framework, you've worked with fair presentation as well. So you have to refer back to the conceptual framework and do some revision so that you know what fair presentation means. Number two, going concern. You also came across that when we've done the conceptual framework, and the same thing applies to the accrual basis of accounting. The fourth general feature is presentation consistency. First, frequency of reporting. 6, materiality and aggregation. 7, offsetting. And 8, comparative information. Now, this is the summary of IAS1 done by BDO Spencer, more or less in a one-pager. Oops, there you are, there's the records. So let's look at all these journal features one by one. The first one is fair presentation and compliance with IFRS. We say that financial statements are required to be presented fairly as set out in the framework. Now that framework is the conceptual framework and in accordance with IFRS and are required to comply with all the requirements of IFRS. Now, financial statements should fairly represent the financial position of the entity, the financial performance of the entity, as well as the cash flow position of the entity. And how do we achieve that fair presentation? Well, that is achieved by the faithful representation of the effects of transactions, other events and conditions in accordance with the definition and recognition criteria for assets, liabilities, income and expenses as set out in the conceptual framework. Now, that seems to be like a lot of big words that we have thrown around here. But if you think back about the conceptual framework, that is exactly what we've said under the conceptual framework, what faithful representation is. So I want to see the effects of the transactions faithfully represented, truthfully. It must be a real reflection of what actually happens. And the same thing applies to other events and conditions. What do I have to use as my rules? My rules is the definition and the recognition criteria of elements set out in the conceptual framework. So there we have identified things like assets and liabilities. We have defined an asset, we've defined a liability. We even went further and we've defined non-current and current assets, non-current and current liabilities. So we should know that those assets and liabilities, financial statement where they belong to is the statement of financial position. Similarly, we have defined income and expenses, and we should know that income and expenses, the financial statement where they are actually going to be represented in is in the statement of profit or loss and other comprehensive income. So it's not now only the definition and the recognition criteria that is important. It is what do I do with that element? Where do I park that element? What is that element going to mean if I want to interpret the results? And if I want to interpret results, my financial statements must make sense. Otherwise, I will not be able to do so. The second thing is the going concern principle, and that's the second general feature of general purpose financial statements. And we say that you know what the going concern principle is. The going concern principle is that we assume that this entity that we are now reporting on is going to exist in the foreseeable future. Now, it was sort of a given for most entities that we worked with in the past. But COVID-19 has changed that playing field completely. Guys, especially if you look on certain sectors of the economy, things like the hospitality industry, guest houses, hotels, tour operators, those guys haven't done any business. Gyms, think of gyms. They were closed for 5 months of the year, nearly 6 months, if they want to get their house in order before they can actually have some clients again. Now, most entities, most businesses are not able to survive if they have to close down for half a year. How? If you have to pay certain fixed costs, in other words, things like rent, I cannot do anything about that. Whether my doors are closed or whether my doors are open, I have to pay my rent. Certain other expenses like a minimum amount of salaries, if I want to retain my staff because they know what they're doing, they've served me well in the past, I do not want to lose them, but I cannot earn any money, so they sit at home and I have to pay them. So now suddenly the going concern principle becomes much, much, much more important in these days that we are living in. So what is the difference then by compiling your financial statements on the going concern principle, opposing that I expect that, or the going concern principle is a little bit doubtful? Well, it is not sure that this entity is going to make it. I'm not going to prepare my financial statements based on the historical cost basis or the fair value basis. I'm going to prepare my financial statements on the liquidation basis. Now, what does that mean? Guys, everybody knows when somebody is in trouble, and everybody is in to get a bargain. So if this entity had certain assets, and those assets could have been used by the entity quite valuable, but now he has to get rid of his assets in order to cover his debts. And everybody's in for the bargain. So therefore, the amount that I'm going to get out of a liquidation point of view, liquidation is if I sell my assets now, how much am I going to get for that? That is liquidation. So if I have to sell my assets now, probably 99.9% of the times, you are going to get less for that asset than the value at which that asset is reflected in your books. Now, how do I decrease an asset? I have to credit an asset. So that means I have to pass a debit somewhere else. And where's that somewhere else? The income statement. And what does debits in the income statement causes? It causes losses. So at the end of the day, what's going to happen to my asset, liability, / equity position of the entity as reflected in the statement of financial position is going to reduce. And if you're going to wipe out your equity, this entity is not going to make it at all. So then they have to liquidate because they are insolvent. The accrual basis of accounting, you also come across there. What does that state? It says, well, we recognize income when we've earned the income. And we recognize expenses when we incurred the expense. And in both cases, it does not matter whether cash flow has taken place or not. So therefore, we accept that we're going to prepare our general feature financial statements on the accrual basis of accounting and not on the cash basis of accounting. Presentation consistency and frequency of reporting. Let's look at presentation consistency. If I have decided to apply, for instance, the first in, first out method of inventory valuation, I cannot chop and change because if I apply the weighted average method of inventory valuation this year, I'm going to get a better result. It's going to flow through to my income statement. I'm going to make more or less profits depending whether I want profits or whether I don't want profits. Guys, you never want too much profits as well. If you had, let's say, a 500% increase from last year to this year in your profit figure, you will be tempted to stash away a little bit for the rainy days, which is still coming in the future. However, out of an accounting perspective, you are not allowed to do so. Why not? Because it will not be a fair presentation of the transactions that happened during the year should I defer some of that income to a future period. So therefore, if I have chosen a certain accounting policy, that policy must be applied on an annual basis consistently. Why? So that if I compare my results of this year with those of the previous years, it must be 100% apples and apples, and not apples and pears, apples and pineapples, and apples and bananas. So at the end of the day, I want to prepare my financial statements exactly on the same basis. Right. Should there be good reasons for me to change my accounting policy, then I have to disclose the fact that I'm going to change my accounting policy to the readers of the financial statements, but that is not where I'm going to stop. I also have to reconstruct my comparative figures. so that I'm going back a couple of years, reconstructing based on my new accounting policy my figures, so that the reader of the financial statements can see exactly what is the impact of the change in accounting policy currently and what would it have been in the past if I had applied that new accounting policy previously. So again, once I have reconstructed all my figures, now I can look at apples and apples and apples and not apples and bananas or apples and pears. Frequency of reporting. Well, if you're a listed company, you have to report your financial results. You have 6 months after year end to report your financial results. But it doesn't matter whether you're listed or not listed. It is a requirement that at least for every financial period, which is 12 months, you have to report thereafter the financial statements of the entity. Now, why? Guys, because so that all these users of financial statements can see exactly what is your asset liability situation, what is your cash flow position, and what is your profit position, all measured in the different financial statements. So at least once a year. If you are not able, let's say you have a financial year end, argument's sake, of 31 March. I'm thinking now, for example, when ABSA was first taken over by Barclays in England, Barclays had a financial year end of 31 December. So that very first year after Barclays took ABSA over, ABSA's financial statements or its financial year end changed also to 31 December to be the same as that of the holding company, Barclays PLC. Now, so for that specific period, the financial statements would have been compiled for a 9-month period. Now, there's nothing wrong with that because that is a normal practice that if you have a holding company and a subsidiary, i.e. a company that has shares in another company and you can exercise power over the control over that entity, that all these entities' financial year end must be the same as that of the holding company. So if something like that has happened, I must disclose the reason why my financial period is not a 12-month period, why I've changed my financial year end from 31 March to 31 December, and then I have to give comparative figures for the same period, i.e. the 9 months period of last year, exactly from the 1st of April to 31 December last year, comparing to the 1st of April to 31 December of this year, so that the reader once more can see what does apples to apples look like. So he can compare the results with each other. There's very little value in to compare 12 months results with 9 months results. So the previous year, the financial period was 12 months. The current financial year, the period is only 9 months. How can I leave out 3 months and then still think it's comparative figures? You can't. So you have to or give the reader of the financial statements the corresponding figures for the same financial period of last year so that he can make a judgment call. Materiality and aggregation. Now, materiality is established with reference to both the nature and the size of an item. Now, what does that mean? What does that mean? Well, the nature of the item, if the nature of the item is the same, I am allowed to aggregate that item and show it as one figure in my statement of whatever financial statement. Let's take an example. If you think about salaries, what is the difference between a salary and a wage? A salary is paid monthly to the employees. Wages are very often paid weekly or bi-weekly to my employees. So there is usually a wage run and a salary run. And at the end of the day, when we show our income statement, we show as an expense item salaries and wages. So the nature of the expense is the same, whether it being a monthly paid thing or weekly paid thing. What is the nature? I pay my employees remuneration to perform a certain task for the entity. So I am allowed to aggregate salaries and wages, and just show one figure in my statement of profit or loss. If you think about depreciation, I'm writing off depreciation on motor vehicles, I'm writing off depreciation, let's say, on equipment, on land and on buildings per se, not on land, on buildings. And in my income statement, what do? I only show one line item, depreciation. But I have a note to my income statement where I explain what was the breakup of the depreciation. So I'm allowed to aggregate, count together all the depreciation expense charges and only show one figure depreciation in my income statement, but then the reader would like to see what was the breakdown. And in a note, I will give him the depreciation on vehicles, depreciation on equipment, depreciation on buildings, all of my classes of assets. I'm going to break it down and I'm going to give it to him separately. Right. If the size of an item, we say that that is also has an impact on materiality. Now, let's say I have a once-off item. Let's assume that we had property in our books. We have acquired the property, let's say 10 years ago, and then gradually we have revalued the property, and now we've sold the property, and we made a nice profit on the sale of the property. Now, it is not a regular type of item in our books. We do not go and sell our non-current assets every day of the year. So therefore, the nature of the item is as such. It doesn't matter whether it's a big profit or small profit. The nature of the item is as such that we have sold a material part of our income producing capacity, i.e. our non-current assets. And because we've sold quite an important or a material part of our assets, although the profit or loss that we've made on the sales transaction is not a huge amount, the nature of the transaction is as such that it will have quite an impact on the user or the reader of the financial statements. It's going to have an impact on his decision making in the future. He has to know that you have sold a material part of your income producing capacity or your non-current assets. Okay, so therefore, in a case like that, the nature of that item is going to be as such that it is going to cause materiality. Doesn't matter whether the amount is large or small, but the nature of the item is as such it's going to be material, and therefore I'm going to disclose that separately. The following general feature is offsetting. Now, offsetting means I am not allowed to set off assets and liabilities against each other or income and expense items against each other. Let's assume I'm buying a property. Property cost me 5 million rand. I'm going to take out a mortgage loan, local bank, of 4 million rand. Now, it says I'm not allowed only to show in my books a non-current asset of 1 million. What is the 1 million? The 5 million cost of the property less the 4 million loan, the mortgage loan. He says you're not allowed to do that. Why not? Isn't that the net impact of the transaction? Assets less liabilities. Assets less liabilities is 5 less 4 equals 1 million. So what is wrong with that? What is wrong with that is that the value of my assets that I'm using in order to generate income is not R1 million. The value of the asset that I'm using to generate income is 5 million rand. Also, in a situation like that where I've netted it off and only showed the 1 million, do I show in my books any commitments? And now I go to the bank and I say, listen, I want to borrow money. Look at my statement of financial position, as clean as a baby's bum. There is no liabilities whatsoever. So I only showed the 1 million as part of my non-current assets. Obviously, you are misleading the bank because you have future commitments that you have to honor equal 4 million rand, the mortgage loan that you have to repay to the bank. So therefore, it is clear that should I be offset assets and liabilities against each other, or for that matter, income and expenses against each other, I will definitely mislead the users of financial statements. Why do I want to split income and expenses? Guys, because again, I need to show the reader of the financial statement what was the expenses incurred in order to generate a certain income figure. So remember the old matching concept? We want to see if I have spent 100 Rand, did I make 120 Rand worth of income, which gives me then a 20 Rand profit? Or did I spend 100 Rand and I only made 50 Rand out of that 100 Rand, so therefore it gave me a loss of 50 Rand. So I'm not allowed to offset income and expenses against each other. It makes a little exception here. It says unless it is required by an IFRS statement. Pardon me. Now, that doesn't happen very often, but if it is allowed by an IFRS statement, then probably you will be able to do so, but somewhere in your notes, you're going to explain exactly what you've done, why you've done it, and what IFRS statement allowed you to do so. The last general feature is comparative information. Now, that is something that you have to learn, that if I tell you that comparative figures are not required, then you are allowed, and only then you are allowed to ignore the fact that you don't have to give comparative figures. But in IAS 1, it is a requirement that financial statements must always have a comparative figure. So if I show my statement of profit or loss and other comprehensive income for the year, I start off with my revenue figure. I want to see what is this year's revenue for the year ended 31 December 2020, and I also would like to see on the far right hand side 2019 Rand, my revenue figure for last year, the corresponding period was Y amount, so that I can have a comparative figure so that I can see, do I fare better or do I fare worse? So go to Video Spencer, Google them and see what you can get, and that actually applies to all the IAS statements that you're ever going to do in your life. Right, let's look at fair presentation. We say it requires a faithful representation of the financial position, results, cash flow, and the effect of these transactions, other events and conditions in accordance with the definitions and the recognition criteria of the elements as set out in the framework. Guys, you have to do revision of your definitions and through recognition criteria as per the conceptual framework, because I'm going to combine the conceptual framework with IAS 1 when I ask you to do a theory type of question. Fair presentation requires fair judgment and is mainly reached in complying with IFRS. So the general assumption is that if I'm going to comply with IFRS, my financial statements will be a fair presentation of the financial position, results, and cash flow of the entity. The information that is presented must be relevant, must be reliable, must be comparable, and it must be understandable. Go back and have a look at your qualitative characteristics of financial statements as well as your enhancing qualitative characteristics of financial statements. Yeah. Components of financial statements. A complete set of financial statements comply with statement of financial position, a statement of profit or loss and other comprehensive income for the financial period, a statement of changes in equity, and that will also be for the full financial period, a statement of cash flow, also for the full financial period, and all notes that actually explain the items that has been shown in either one of these statements. Now, what is important is to note that all statements are required to be presented with equal prominence. So if your statement of cash flow, let's say, reveals that this management has really used all the short-term cash that was generated by their operations in order to buy new vehicles, which is mainly driven by the top management of the entity, and they don't actually want the investors to see that so very clearly, they hide away the statement of cash flow on page 5,980 and do that in small print and hope that nobody's going to see that. No. It doesn't work that way. All those statements that you see there above must be required to be presented with equal prominence. Now the structure and content, identification of financial statements. Now, financial statements must be clearly identified and distinguished from other information in the same published document and must identify. Before we get to what must be identified, do yourself a favor. Go to the internet and Google any large listed company. You can Google Naspers or one of the banks, but the banks is a different type of financial statement. So Google Naspers, and then you go and have a look how thick and how comprehensive the annual reporting is. So it's not financial reporting only, it's annual reporting. And a portion of the annual reporting are the financial results of the entity. And then you will see, if you look at the table of contents, have a look where the financial statements actually starts. It doesn't start on page 1, probably it will start on page 100. But make sure that the reader of the financial statement can see this is now the financial statements that we are talking about. Remember, when you are the auditor of, let's say, Naspers, you do not have any opinion about things like the strategy documents included in the set of in the annual report of Naspers. You do not express an opinion about the vision and mission and all that kind of things. About the social responsibility. That's not what auditing is about. That is not where you're going to grant your opinion on. You are going to give your opinion on the reasonableness of the financial statements. Is the financial statements a reasonable reflection of the transactions and events and everything that happened in the entity for the financial period under the review? So it is very important that the reader of the annual report must know exactly when he's going to start reading the financial statements, which is included in the annual report. Now, important information is things like the name of the reporting entity, Naspers Limited, whether the financial statements cover the individual entity or group of entities. Now, remember, in the Naspers arena, there are a lot of entities, a lot of companies. So Naspers has shares in all those companies, and all those companies, we call them subsidiaries. All those companies are subsidiaries of the holding company, and the holding company equals Naspers. Now, what happens in a situation like that is Naspers has to prepare consolidated financial statements as well. Now, what is a consolidated financial statement? That means that would be Naspers, the company itself, their financial statements, as well as their share of the profits of all these other companies that they have shares in, all these subsidiary companies. I'm going to add all their share of their profits together, and that will be reflected in the consolidated Naspers report. So you will see that there are two sets of financial statements. The one being only the entity itself, Naspers, the company, and the other one will be the consolidated results of Naspers, which will then entail Naspers and all the subsidiaries. Right. So it is very important that the reader must know, do I only work with Naspers, only the individual entity, or do I work with a whole group of entities, Naspers and all the entities that it has shares in? Now, in the individual entity, it will only be an investment entity. So it will be where they keep all their investments in all these different share investments in all these different subsidiary companies. But when we look at the group of entities, that will be then all the profits added together, all the assets added together, all the liabilities added together, and that will be reflected in the consolidated financial statements. You want to see the statement of financial position date. So you want to see that the statement of financial position as at year end, 31 December 2020 for argument's sake, or the statement of profit or loss and other comprehensive income for the year ended 31 December 2020. So you want to see that period cover. the presentation currency. Now guys, that is very important because the presentation currency means, if I think about NASPASH again, NASPASH report its results in US dollars, not in rands. So there is quite a difference of having $1,000 in the US dollars in the bank or 1,000 rand in the bank, you must agree. So therefore, it is very important that when the reader of the financial statements look at these figures, they must be able to judge how much is this entity actually worth. And if he just assumes that the financial figures are presented in rands, he's going to make a huge mistake. Instead of looking at that and see that the currency that they use in order to compile their financial statements is, for argument's sake, US dollars or pounds or whatever, euros or whatever the case might be. Then very important, the level of rounding used. What does that mean? Guys, go and have a look at the bank's financial statements or NASPASH again. We're talking about billions of rands or dollars or whatever the reporting currency is. Now, if you want to confuse the living daylights out of somebody, then you write down a figure 123 space 456 space 899 space 432 space blah 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 blah. So we don't do that. We say, well, we're going to look at the closest level of rounding that the figure still makes sense. So if I'm not a big entity and I disclose the exact figure, then it will only be a rand. So there will be on top 2020 results, underneath rand. And then I know it's a full amount. If I'm a little bit bigger, and let's say we're going to do our disclosure in rand thousands, then it will be 2020 or 000 apostrophe S. And that is then rand thousands. If I'm still a little bit bigger and I want to disclose my figures in rand millions, then it will be 2020, underneath that a big R and an M. So then it is rand millions. So if it is in whatever denomination I'm going to use, I will indicate that by the number of zeros that I'm going to put behind the rand. So very important again, so that I know exactly how big this figure in actual fact is. The statement of financial position, that is our first financial statement that we're going to look at. And we say, well, in that statement, and this you know, we're going to present the current and non-current items separately, or if we're going to present that in order of liquidity. But if you think about in order of liquidity, now what is the order of liquidity? That is how quickly I can convert this asset into cash. It will take me longer to convert a non-current asset into cash than a current asset. What is a current asset? Inventory, that should go fairly quickly, that I can convert it into cash. Debtors, well, hopefully they're going to pay me within 30 to 45 days, so that's fairly quickly. And bank is bank, so it is liquid. So therefore, if you think about the statement of financial position that we've done, we always started with non-current assets and then current assets underneath that. Important that you know what is the definition of a current asset. A current asset is expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle. Now, you should know what is a normal operating cycle as well. Now, normal operating cycle, that also differs from entity to entity. It all depends what type of commodity they're actually trading in. And that is how long it takes from where this process starts, where I acquire the product or commodity that I'm trading in, where I acquire that one, where I sold that one, and where I've earned the money or received the money for this commodity that I've sold. That is the length of the normal operating cycle. Now, let's read it again. The current asset is expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle. It must be held primarily for trading. It must be expected to be realized within 12 months after the financial year end. That must be added there. And it must either be a cash or it can be a cash or cash equivalent. all other assets, so assets that still an asset, so it actually adheres to the definition and the recognition criteria set out in the conceptual framework of an asset. They say all other assets are required to be classified as non-current assets. Simultaneously, what is a current liability? That's a liability that is expected to be settled in the entity's normal operating cycle once more. It's also held primarily for trading. It's due to be settled within 12 months after the financial year end. The entity does not have an unconditional right to defer settlement of the liability for at least 12 months. What does that mean? Well, let's say that you have reached an agreement with your creditor. You say, well, listen, I'm going to pay you, but you must give me some extension on the date. And he says, okay, well, you can pay me over after a period of 15 months. So after year end, there's still 15 months before I'm going to pay him. Then it's not a current liability anymore. And that will then be classified as a non-current liability because I have deferred payment for longer than 12 months after the financial year end. Now, all other liabilities are required to be classified as non-current liabilities. Now, information required to be presented on the face of the statement of financial position is detailed in IAS paragraph 1.54, and the rest is IAS paragraph 1.79 to 80. Guys, it's not necessary to go and have a look at what that paragraphs are actually saying. I have attached for you a set of illustrative financial statements in the study unit. You have to know that set of financial statements by heart because that is all the stuff that you need to know how to disclose according to IAS 1 for your year of knowledge. If you're going to look at the bigger IAS 1, you're going to see a lot of items that you do not have the slightest clue what it entails or what it stands for. And you will come to learn about all those items in the coming years, but not for this year. So it's going to cause so much confusion that it's really not worth your while. So go and have a look at the set of illustrative financial statements that I have attached in the study unit. Make sure that you can exactly do everything that is disclosed there. Also, you have to do all the activities in this study unit because some of the stuff that's not really in that set of financial, there's very few of them, that is handled in the class or in the examples that we're going to do hereafter. Right. Do you see this? 2 and 2 equals 5. And this is what we call creative accounting. Now you listen to me. Never, ever, 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 ever in your life, you have to be guilty of creative accounting. Creative accounting is the reason why Steinhoffs in life happens. It is a reason why a lot of money is being lost by the investors. And remember, some investors are things like pension funds. What is a pension fund? They take all the old people's money and they invest it in certain stock, trying to make the money more. And now, something like Steinhoff used to be seen as quite a good investment and a good company and a quite profitable company. And then they invest those poor people's money in entities like that. And then Steinhoff happened, the whole thing came to a standstill, the whole thing crashed. It's a miracle that they're still in existence. And why? As a result of creative accounting. What do we do when we do creative accounting? We create fictitious assets. The assets got a debit. So if I want to bring in a debit, I also have to bring in a credit. It's very little sense to bringing in a liability. So what if I achieved based on what is the impact of that on my equity? None. So what do? I create an asset on the one side, so I increase my asset level, and the credit I take to income. So what do I do with that? I increase my profits. And the profits goes to equity, and equity is representative of the wealth of the entity. So what happens to the wealth of the entity? It increases. And that is creative accounting. And that is where the poor hits the fan and a lot of people actually loses money.